Hello everyone, very warm welcome to the after lunch session. Before we start, I would really like to thank Swiss Sustainable Finance and Kelly and Sabine for the invitation. It's very timely for us to be here because blended finance and social impact investment are peaking in January on the OECD side, I would say. So we are very happy to present our latest results here on blended finance to you. First of all, for those of all you who don't know the OECD, we are basically a policy-making organization who are engaging in data and data standards, in analysis, and also providing policy guidance to our government members. So we also do this in development finance, where Haje and myself are working, and in particular on private finance for sustainable development, as we call the division now. So bear with us. We have a lot of material today because we are the OECD and we like data and we like evidence. So we have a lot of slides today. I will start with the first. I will start with the first overview about key facts and figures on blended finance before Haje will then go into our latest research on blended finance, the definition, the principles which have been endorsed last year by the DAC members, and some partnership models and insights, so the reason why we're all here today. And of course, at the end of the day, we have some time for questions. So the reason why the OECD is engaging in researching private finance for sustainable development, we've heard that today a couple of times, also from Karen Finkelstone this morning. There's this massive investment gap which needs to be filled in order to improve people's lives as promised until 2030. At the same time, this is benchmarked by a not sufficient amount, even though a high amount of ODA money, so official development assistance money. But in order to increase the impact of this money, donors are more and more engaging into investing this strategically in order to mobilize additional private finance into their development finance projects. So what we found basically is that already a couple or many of the DAC members which we are catering to have already set up blended finance projects and blended finance programs. But still there's a limited evidence base, so we don't know at this stage, and we've heard that this morning a couple of times, we don't really know what's working, what's not working, what's the development impact, and what are the amounts. So this is why we engaged in some research on that. So a couple of you in the room have last year participated in an OECD survey of blended funds and facilities, and these results will be published later this month. And what we found actually, as I just mentioned, more and more DAC members are engaging in models which are mobilizing the private sector. So for instance, funds and facilities. So when you see here over the last decade or more, there's an increasing amount of funds and facilities set up by donors targeting the mobilization of private sector into development finance. At the same time, donors are, of course, interested in how much money is actually mobilized by their investment. So what the OECD also does, we have set up a survey to mobilize the amounts and to measure the amounts mobilized from the private sector by official development assistance, as we very bureaucratically call it. So this is actually the mobilization effect we have been talking about the full morning. So we put some figures behind it. So what we see is basically two things here. What we see from 2012 to 2015, the amounts mobilized from the private sector has been increasing steadily. And what we also see, and we use an instrument-based approach, we see that guarantees are most effective when leveraging private finance here. So over the 4-year period, donors have mobilized about $81 billion, and most of them in the form of guarantees. Some minor mobilization effect is coming from direct investment in companies, but there's also a lot of mobilization going on with this help of syndication, and that's an MDB business model, as we have heard this morning, and also credit lines. Where is this private finance mobilized? And we've heard this morning already that a couple of you are focusing on Africa, and indeed, most of the private finance we have been measuring at the OECD is mobilized in Africa. But there's also mobilization in Asia and Latin America going on, and also some in Turkey, so mainly what is here Europe, the main part. What will be interesting to you is who is engaging in mobilizing a private finance. So first of all, the multilateral organizations are very much engaging in the mobilization of private finance. So they account for 2/3 of all the amounts mobilized we reported to us. And what we also see here is the interesting variety in the instruments, in the financial instruments which are used to mobilize private finance. So, for instance, EIB is making use of credit lines exclusively, almost exclusively, whereas MIGA, of course, has been set up to issue guarantees. On the ad fee side, which might be also interesting for this audience here, we have heard this morning from Nick that CDC is investing a lot in equity or in shares in investment funds, and you can see that here in their high mobilization effect with the help of shares in collective investment vehicles, as we call it. And then other DFIs are a bit more have a bit more variety in terms of the instruments they use to mobilize private finance. But in total, we see that CDC is leading this group here. So I will like to hand over to Haje, who's presenting blended finance in more depth with a policy view.
Thank you, Wiebke. This was actually quicker than anticipated. Looking here for the timekeeper. So you will not be surprised that OECD is very much into the business of defining. So we like to do this. We just last year proposed and got accepted a definition that you will see here. So we define blended finance as a strategic use of development finance for the mobilization of additional finance towards sustainable development in developing countries. You see this graphically. What you see here is that the basic issue is really that basically money that has a development purpose is being used to mobilize commercial funding. So for those of you that have been around and with this for a while, there are two connotations which are somewhat less important, we feel, going forward. It's a public-private, so there was understanding whenever the public goes out to the private, that's kind of blending, and also the issue of having concessional versus non-concessional funding. So whenever, if you like, the public provides concession funding for non-concessional financing, that is blending. We feel that this is valid, and a lot of blending happens of that. But given the big picture that we described and that colleagues lined out in the course of the morning, strategically, really, we are looking into mobilizing, we should be looking into mobilizing capital that is non-development, i.e. commercial in nature, for funding the SDGs. Last year, we developed, with the help also of the private sector, of CSOs, of public policymakers, a set of OECD Blended Finance Principles. These have been endorsed just in October by the ministers for development that are members of the OECD, and these ministers, they come together, and on a regular basis they are representatives in the so-called Development Assistance Committee, the DAC, and they represent about 90% of the total ODA, so the official development aid. So it's a quite powerful group, if you like, that is determining very much the concessional part of development finance. And so these 5 principles were endorsed by the ministers. Principle 1 is basically when you go into blended finance, you should do it for a development rationale. The second one is, once again, this orientation towards the mobilization of commercial finance. Third one is, whenever you do this, really blend it and tailor it to the local context with the interest of having impact, but also sustainability and scale eventually. The fourth one, you will see this, given also the subject of today, is the focus on effective partnering for blended finance. And each of these principles have a couple of sub-principles below that. And the sub-principles there is to say, well, we have to acknowledge that when public and private come together, they have different mandates, but they should respect their different mandates. There should be a fair allocation of risk among these set of partners, and then eventually they should strive rather for a scale and scalability of whatever they do. And the fifth principle, you will not be surprised, as this comes from somebody from the OECD, that we feel there needs to be also more transparency and also transparency and monitoring about the results that are actually taking place. So these are endorsed. They're rather high level. And in 2018, the DAC and the OECD will work on providing, if you like, a set of a policy guidance note that looks into basically how do you implement these principles. I should mention here, we're also coordinating the major initiatives that look into blended finance nowadays. There's one group, and Karen, IFC, is coordinating that brings together the MDBs and the European Development Finance Institutions. That's one big group. They look more onto operational aspects, if you like, of blended finance. And then there's another group, just to mention the second one, that is by the Business Commission for Sustainable Development. Jeremy Oppenheim is the person that is leading that very much, that looks into how can we mobilize institutional capital for blending in developing countries. And Jeremy is going to present the results of his work. We're very knowledgeable and very well-known institutional investors are represented in Davos now, basically. Let me say that what we are presenting here has obviously led to a couple of policy insights, a bit of propaganda here from my side. All these are published in this report, Making Blended Finance Work for the SDGs, to be out in 10 days. So it is, we believe and we hope, quite a sizable piece of research, data, analytical work, but also policy implication, and also the some of the insights more in regard to the partnership models that I'm going to present now, and that actually Wiebke did the research on and drafted that, also coming in this report. Just to say, when we look at partnerships between the public and private sector, there are different types of partnerships. I think in the morning we very much heard about, if you like, transaction-based partnerships, so those that you find on the left-hand side, be it the establishment of funds, and for example, Claudia from KfW made a couple of references, but also on, more at the level of projects. Just to mention that of different partnerships, there are different categories which we refer to as the institutionalized kind of partnerships. Here as an example, SDIP, some of you might be a part of that. That's a partnership that was launched in Addis in 2015, where basically the public and the private sector, so very big players also from the private sector, like Deutsche Bank, but also Citibank and others, and from the public side, for example, Canada, Sweden, and others involved there. They basically, the idea is they come together to exchange and discuss about concrete activities, investments, especially in the investment, in the infrastructure investment area, and move that forward. I think Raimund Fohr was very much saying that he sees a paradigm shift taking place. We would concur with that, coming out of our research, that we see more and more, if you like, a more partnership-typish cooperation with project proposals being shared between partners. We see an involvement of institutional investors and rating agencies getting more and more involved upfront, and obviously we're also seeing governments engaging much more broadly. I mean, Switzerland being certainly a government with its agencies that have been involved in this area for quite a while. There are other DAC members, other OECD members who are just getting into this area. So the capabilities among OECD members are quite different. A couple of insights. I'm going to say a few words about these. The first one is, you will not be surprised, is that we think that blended finance approaches need to have a stronger focus on mobilizing commercial resources. The reason being, I mentioned that previously it was quite about basically mobilizing with public money. As I said, we believe it really the focus should be very much from the very beginning of basically aiming to mobilize commercial resources for ownership, for scalability, for sustainability, and that basically whenever public sector engages here in blended finance, it should also be with a clear understanding that this is only basically on a time-based basis. So the exit should be already part of the entry. Just to say, I mean, for you from the private sector, this might be a very straightforward. It is not so. It is a kind of a learning exercise that has taken place in many of the public sector players, basically to have this, if you like, the mobilization of commercial capital in mind as a framing. The second insight is the issue is that obviously development finance providers do have an added value in a lot of the engagements. It is not only funds, but also, as you have learned and listened to this morning, I mean, we talk about funding that helps to enable environment, something that Karen Finkelstone from IFC very much highlighted. It's the whole issue, I think the colleague from SECO, Ivo, was mentioning that obviously a lot of the TA grant funding helps to basically build capacity. I think I would also like to acknowledge that quite often these development finance providers have a lot of market knowledge, they have a lot of networks, they know whom to go to in local markets. They have a long-term horizon. I think the gentleman from Swiss Re was indicating, obviously, that quite often these transactions take a long time. This is something that a lot of these development finance providers feel very, very comfortable with. There's an image issue. And then I think not to underestimate, it's obviously that these actors quite often have good contacts to local governments. So if something goes wrong, it helps if you know somebody that can go directly to decision makers locally. And as you may have read, is that quite often also, for example, Moody's, the rating agencies involve the fact when development finance providers, like in the example here of a hospital project in Turkey, if MIGA and EBRD is involved, that is then also being seen as credit positive. So you you can increase the rating of your transaction if you talk about a big one to allow for bond issues, for example. Here, the third insight is about this balancing of scalability, i.e. making things simple and standard with the issue of individualization. I think we had heard, for good reasons, very much a pitch toward make it simple. Don't overcomplicate things. Look at what you have done and kind of, maybe decrease the structuring, the internal structuring of special purpose vehicles. On the other hand, and that's a bit here, the second bullet point is obviously that I think the public sector, when we come along with public money, you have to justify why you're engaged. And quite often this justification goes along with addressing new challenges. And new challenges are typically complicated. And so in a way, as part of the business model of development agency is the fact that this is time-bound. And when you do something at the beginning, it tends to be first initially complicated, and only once you learn, experience gains, you can move the whole thing towards a more streamlined issue. Quite often you can find simple answers to complex questions. That's obviously even best. But nevertheless, there is this kind of built-in tension of, I think, going into developing emerging markets on one hand with a financial product, and on the other hand, the need clearly in order to create the scale of what we do of keeping things simple or making things more and more simple and standardize what you do. Transparency. You might be surprised. Some of my colleagues in the public realm are hesitant to be really transparent about what they do. I think there's a competition issue involved there. There's something, we don't really have the data and don't really have the capacity. There is the issue that some of the actors say, there are confidentiality issues, legal confidentiality issues, which prevents us to provide this kind of data on terms and conditions. Yes, that might be still so, but I think as, for example, Nick from CDC this morning was saying, really talking upfront among partners of, what is this all about, who gets what kind of subsidies, what is the time-boundness of this is really important for increasing the market and having really efficiency in the market building. It is a challenge, but just to say that we, over 1.5 years, negotiated something on private sector instruments with our DAC members, and the transparency issue was a sticky point. And even providing data to OECD was something that quite a number saw rather with cautious. But it's interesting that quite often the private sector player very much say, well, you're sitting on so much data about these markets, please provide them somewhat more openly in order to allow the private sector to come in once again with the objective to scale. The second but last insight we would like to share with you is this issue about the private sector being involved in blended finance products. So typically in the past, if you like, the public sector would develop something and rather at the end would then go to the private sector and ask, well, would you like to join? You can imagine that was not always received that positively. I think as we heard this morning, it's more and more now more of a partnership from the very beginning with the private sector. It's an interest, a capabilities, but also constraint being part of the discussion very early on. That sounds in principle good. If you talk among these, the issue is quite often that the capacity, for example, of institutional investors are rather limited. A typical insurance fund or so has a limited number of staff that will allow them basically to go along with some development banks to structure new ideas. And we heard that a bit from the colleague from Swiss Re there. And then there's the whole issue of culture, of languages differently. The issue that the private sector has a rather shorter time horizon, decision makers quicker. So there's quite a bit, we believe, of if you like, cultural change and learning from each other that is necessary. It requires, frankly, also both the public and private side to move out of their comfort zone and listen to the other side and learn from each other in order to have this kind of public-private cooperation really to lift up. And within a group I was involved, we said, well, we're no longer talking about public-private partnerships, but we rather talk about profitable but painful public-private cooperation, because it has to be profitable for the private sector to come in. It's painful because it's not easy. Also, the partnership is public-private, and it's not the classical partnership model that a lot of us know from the investment world a couple of years ago, but it's a new form of cooperation that we are just developing. I'm coming to my end here. The last insight is about the issue of calibrating the risk-return relationship. And we say, well, at times this also requires concessional financing. The example that you see, a lot of you will know this, the Lake Turkana wind power project, a big renewable energy project, windmills in the north of Kenya, massive one, 15% of Kenya's power comes out of it, a lot of parties involved, initially led really by the private sector, and then due to long due diligence processes, it was basically then really necessary. For example, I think in this time it was the EIB with the finance from the European Commission to step in, provide a bit of a sweetening to all the whole thing in order to have this big flagship project to materialize. But I think what we are saying is if you provide concession financing, this should be really context specific, it should be time bound, and it should be decreasing over time, and thereby allowing more and more commercial capital to come in its own motivation and mandate. So that's a quick run through of some of the data, the policy work that we're doing, and some of the more operational insights. And with a view of the next sessions, maybe to say really Blended finance currently still is very much context specific, and I think that's the focus of the next 2 sessions. But obviously, in order to really have scale, we need to come up with new and innovative solution. Some of what has been mentioned here, the portfolio approach of the IC sum, the work with aggregators that the colleague from Swiss Re was referring to, and others, that really allows us, the institutional partnership that I was mentioning, that allows us really to scale up the funding for the SDGs. Just to say, while I listen to the kind of conservative and cautious remarks by the private sector when it comes to the SDGs, I think internationally for the public sector, this is the framework, frankly, and I think whenever you as a private sector will talk to government people that are deciding about the money, the SDGs and the so-called 2030 agenda is really the framework for which the public sector aims to support, and the funding is being geared towards that support of that framework. And with that, over to you. Thank you.